the biggest companies and the most profitable companies that have ever existed are spending a ton of money on semiconductors, and that is just a fact.
This AI new supercycle, I think it's more akin to, honestly, the Industrial Revolution than it is to, say, the emergence of the internet.
The entire supply chain, I would argue, is underinvesting. Hyperscalers are just simply unable to keep up. CapEx continues to increase. Nvidia's hunting the bulls, right? These guys are hunting smaller prey, but maybe even they're turning up and eating the bulls as well.
Got a very special conversation today. We're going to be talking all about semiconductors. So pleased to welcome for a sponsored fireside chat the team from VanEck, Angus Shillington, lead semiconductor analyst and deputy portfolio manager at VanEck, and Nick Frasse, product manager covering thematic suite of ETFs at VanEck, including SMH and SMHX, the VanEck Semiconductor ETF and the VanEck Fabless Semiconductor ETF. Gentlemen, welcome to Monetary Matters.
Hey, Jack.
Thanks for having us.
Great to be here.
The amount of money being thrown at semiconductor, artificial intelligence, CapEx, is over 1% of GDP. So it really is a macro story. And I think you could make the case that what is powering this economic cycle higher is it was the labor market, it was consumer spending. I don't think it is a labor market anymore. I don't think it is consumer spending anymore. I really think that a dominant driver of this economic cycle is the spending on AI. So it's a macro story. VanEck's got two leading products, SMH, the VanEck Semiconductor ETF, and SMHX, the VanEck Fabless Semiconductor ETF. Angus, I want to start with you. How are you thinking about this space, and where do you think AI CapEx is going to go?
I think it's probably helpful just to set the table and who Nick and I are. So basically, I'm an active analyst, PM, risk allocator. So I don't technically work on the same side of the business as the ETFs. I actively invest client capital. What I say is going to be pretty much aligned with how I'm currently investing. To be very clear, it's just I don't raise capital for ETFs. Let me make one huge point here, because I think it's important to hang the rest of this conversation off. Like, this whole space, semiconductors, equipment, used to be very cyclical. It was very competitive. Many companies did the same thing. They tended to overbuild at the top and then ended up with huge inventory overhangs. Where we are right now is we have pretty much monopolies all the way down the stack. And when we talk about SMH, we talk about monopolies on monopolies, which is pretty much where it is. Now, my point on Nvidia is a very good read on what's happening in the ecosystem, right? So they're the apex predator of GPUs. You've also got on the right of that Broadcom, which are doing more custom designs for customers as well. But if you think what Nvidia are saying, you can then take to the next guy down the stack, which is TSMC, cross-reference it, because TSMC is like 70% market share, and then you can take it to the guy who makes the memory, which is Hynix. They're about 70% market share. So CapEx, right? So again, to sort of put this into sort of the thesis framework, I kind of feel like there's market structure, right? So that's demand and supply for semis. There's sort of technology inflections, so what's coming up the pipe in terms of disruptive or breakthrough innovations, and then what's the sort of AI roadmap. In terms of demand, my conclusion is we have sustaining technology in AI, right? And I think that's pretty easy to understand. But this is not a VC-led initiation. The reason why that's important is you already have scaled, profitable customers who have massive cash flows, right? So we went straight off the bat knowing that the incumbents, the Googles, the Metas, were the buyers. They are massive companies. They are massively profitable. And so they start from a very high speed. So I think that's why it felt unusually big. And then competition within all of those guys is just a huge part of going forward. So I feel like a core point here is that hyperscalers are just simply unable to keep up. CapEx continues to increase. So if you just simply focus on the hyperscalers, I think we think about CapEx as one, internal demand, right? The profitability metrics, how much is AI helping Meta? It's huge in terms of ROI and advertising, sourcing advertising, building advertising, directing it. So that's one. External demand, that's how much new products are in demand. And I think that's where I go to Google's last earnings, where Sundar Pichai admitted he made a mistake he wouldn't make a year ago. A year ago on his, I think it was his 2Q call, he said, the biggest risk right now is underinvesting in AI, not overinvesting. And then 1 year later, he simply said, to use the Jaws meme, we're going to need a bigger boat. He'd simply underinvested. So I think that's a huge part, the external demand. And then the other big driver is competition. So OpenAI, some startups are putting a sense of urgency behind all of the other guys in the sort of hyperscale consumer internet space that they just simply have to keep going to defend their patch. So those three pieces together, I think, really drive the CapEx story overall.
So when you talk about internal demand, that's companies buying the GPUs, Nvidia's chips, to use themselves. So Meta is buying them to improve their ad algorithm. OpenAI or other chatbots and AI companies are buying them for their use. But then there's the hyperscaler external. So that is Google, Microsoft buying the chips to run in their data centers so that other companies can then rent that compute from them. So that is the hyperscale model, and that has been an extremely profitable business model. And I think, Angus, one question I wanted to ask was, what is this a bubble? What's the difference between the current AI boom and the dot-com boom that ultimately led to a telecom bust and a dot-com bust? Because I think as a percentage of GDP, I've seen some estimates that actually AI CapEx actually exceeds telecom investment as a percentage of GDP from the late 90s. But you already answered that because you said this is not driven by short-term inflows into venture capital-backed companies and then the funding could dry up. The customers are the most profitable and best capitalized companies that have ever existed. So that's one difference right off the bat.
That's totally spot on. And what we're talking about here is only data centers. Like, you've got to add in sovereign AI startups. And I think there's another entire layer of application-specific AI that's not yet built. And that's going to be more deterministic rather than probabilistic. But all of this sort of come together, I think, in much more ROI. But I think for your listeners, probably the right way to think about it is through the analog of Internet 1.0. So there are two pieces to it. Piece one is infrastructure. So that's what we're building in the AI data centers. And then piece two is the application layer. So the sort of early sort of 97s, 8, 9, 10, 2000, that was the laydown. It was a completely different form of much more CapEx heavy, low ROI type infrastructure. But let's just say that was phase one. And then phase two kind of started in 2007 and 8 when the iPhone turned up mobile internet. And that really got the whole monetization piece ballistics. Amazon listed, yeah, it went up a fair amount in the sort of blow off into 2000. But that share price failed for until 2008, 2009. So I think that's how you want to think about it. The difference between the two is that the infrastructure layer is semiconductor heavy and the application layer will be semiconductor heavy because the core input value is always going to be data.
I would quickly add to that too. I think it's very natural for people to associate the dot-com boom with this AI just because it's in more recent memory, right? A lot of investors were in during the 2000s were in the market, right? So it feels, I hear back from clients like, when we're doing calls, is you're just waiting for that other shoe to drop, right? You're waiting for that bubble to burst. But I try to reiterate the idea that although things rhyme between the dot-com boom and this AI new super cycle, I think it's more akin to, honestly, the Industrial Revolution than it is to, say, the emergence of the internet, right? The internet largely was a global marketplace, bringing people together and creating a much smaller world for us to do business in. Whereas the Industrial Revolution changed the way that we interact with the world and the way that businesses are run. This is a technology that's changing the way that we're interacting with the world. And it's okay to be constantly watching for what might be a bubble. Is it overspend? But we're not talking about laying fiber optic cable and creating a global internet. You're talking about the way that we interact with the world and a new technology that is completely changing it. So it's a much longer tail thing. Can you have price reversions to the mean as we go through this? Absolutely. But it's important, I think, to put that in the framework of context to understand how revolutionary the technology is.
Thanks, Nick. And later on, I want to talk about the two VanEck ETFs, SMH and SMHX. SMH dominant in the semi ETF world in terms of assets under management and in terms of performance, and then the newer innovation with the Fabless ETF. But let's just stick within the semi space for now. Angus, we had a recent Nvidia earnings call. What were your learnings from that call? What stood out to you?
So there's a lot you can read out of earnings. So I think they were pretty good. But Jensen made a couple of points, right? One, as agentic and thinking kicks in, and we're all experiencing that now, there are a couple of vectors of just hyper growth. One is it's orders of magnitude more token usage. and orders of magnitude more efficiency. So what that is, more demand for the output of the GPUs, and at the same time, more demand for the GPUs because they're much more efficient. So I think that would be point number one. And then I guess point number two is just they gave guidance which was both kind of impressive and strategic, right? They beat expectations without the sort of volatile China stuff, which I think is a bit of a distraction. And then new Blackwell chips are ramping super fast. So the guidance kind of sets a high floor, but also a flexible ceiling. And I think what we've seen over time is that ceiling creeps up. But here's a company which is now the biggest public listed company in the world, right? Putting in 40 to 50% EPS growth a year. That's astonishing, however you frame it. What I saw after the results is analysts upgrading. So that now gives us, mostly in the out years, which is super interesting. So call out more confidence going forward. So the next 12-month kind of EPS growth number is about 40%. So let's put that in context of valuations. 12-month forward, that gives you a P of around sort of 33, 34. That's from a 5-year average of 38 and a 24-month P of about 27 off a 5-month average of 33. Great numbers, great growth. Biggest company in the world should not be growing at 40% like a company that large, but it is, and the multiples look okay.
Yeah, a lot of people in 2023 saying Nvidia's trading at 100 times earnings, looking at trailing earnings, and obviously it is about the future. Angus, one chart I can put it up for on our screen later for our audience, but I'm sure you've seen it just because it's on the front line of Bloomberg. Is the reported is Nvidia sales growth decelerates from eye-popping levels, and they show a year-over-year growth rate in the 2024. Which I think really was 2023. Year over year, the revenue was growing over 200%. It was truly insane. And now revenues are quote unquote only growing at 50% year over year. And I wonder, is that kind of a trap? Because I fell into that trap, and many economists fell into the trap in 2022 with the economy when consumer spending was growing at 20%, and now it's only growing at 7%. We're headed for a recession, and it's no, 7% growth is still a very strong economy. And 50% growth year over year growth for revenue for the biggest company in the world is still dominant.
Yeah, off of an exceptionally high base. And as you said, this is 1 percentage point of GDP growth every year. And yeah, if I go back to my thesis and think, where are we in 5 to 10 years' time? We haven't even started with the application layer. We haven't even gotten started with sovereign AI and the cadence of innovation, meaning, if you bought a GPU 2 years ago, it's somewhat obsolete now. If you've got power issues and you want better power efficiency, you're probably going to upgrade it. I'm not like a rabid bull. I don't think that way. I like to understand what is logical, and what's logical to me is that demand, if you look at the consumer level, demand is there, ROI is there, monetization is there, and there are a lot of parts that still have not yet been solved. So I mean, I kind of feel like we're in early stages. Now, it may toggle between Nvidia and Broadcom, and there are some sort of parts of the demand ecosystem that are not yet clear how they unfold. But I think the big point is this: not to get hung up on sort of short-term relatives and think more about what's the long-term trajectory of AI. And it's pretty incredible. And I think where everybody, so here's make one point which I think is super interesting. I think where most people have got it wrong is the pace, right? So let's take Sundar Pichai, Google. He's got all the data in the world, all the capital in the world, yet he is underinvesting, right? So I think that's the part that you've got to be very aware of. It is the pace of this. And if you're looking out with the binoculars in 2 years' time, you've got to line up both barrels on not just what the linear demand should be, but also what has changed. So when Nvidia talks about improving efficiency of GPUs by 10x and the demand for tokens up 10 to 20x, this is dynamic, and it's not just a binary outcome. The more that AI evolves, the more compute will be demanded.
And just to explain a few terms, CPU, central processing unit, that's the old school chip. GPU, Nvidia invented it, the graphics processing unit they use for parallel computing, very transformational. And then TPU, tensor processing unit. Google is making these, and I believe Google does not sell these to anyone else. They just use them for their own computing. And Google buys a lot of Nvidia GPUs, but I think most, or maybe all, I don't know, is actually for their cloud clients, so for external clients. And Angus, what about China? Because they still are selling into China, but they're not selling that old H2O chip. So they took a big hit in the previous quarter, and that led their gross margin going down from in the 70s to in the 60s. This time, they didn't sell any of those H2O chips into China. They still grew their revenues sequentially. How do you think that they will be able to sell into China? What are your thoughts on the H2O, the Trump export ban, the 15% export tax, and the like?
I tend to think in terms of red light, orange light, green light, right? And I very strong conviction on green, orange and red out the window for me until anything changes. But I think there's an orange light there. I don't know. China doesn't really want them, right? So China operates best under sort of boundary conditions of urgency. So they don't really want their guys, whether it's Alibaba, Tencent, relying on Nvidia, building on Nvidia, because they're less likely to transition or they're less likely to put pressure on Huawei. And then on the US side, the difficulty is like policy framework is just out the window. So is it a national security thing or is it a profit share thing? I don't know. And I think it's very difficult to be logical around that stuff. So to me, it's probably better just to assume it doesn't happen. And if it does, it's a nice bonus.
And the phrase red light implies caution and stop. And red light happens before the car stops. I think with China, like the car already has stopped. So there could be a green light and causing that sales of H2Os into China to go back up again. But the sales into China are down. So it already happened.
I think that's right. Now, the reality is if you buy an Nvidia system, because that's what you're buying now, you're buying networking and racks, and you have to run it on CUDA. And there is a functionality.
And Nvidia is a software system, CUDA, yeah.
Correct, yeah. So you're locked into Nvidia. Now, they have a fix called NVLink, which allows you to make Nvidia gear interoperable with other gear. Now, that's not being sold, and I think it's very unlikely to be sold. So if you're buying Nvidia gear now, and you want to transition to Huawei further down the track, which is what the Chinese government want, it's kind of a sunk cost. And the value prop across the board is difficult. I understand why the US want to sell it in there, but I also understand why China don't want it, which is why it's a difficult one to call.
Nvidia, obviously, they have incredible pricing power. They have had a monopoly on GPUs. Obviously, AMD, they have other competitors, but really they have had dominant pricing power. Do you think that in 5-10 years, Nvidia will continue to be a dominant player with remarkable pricing power? And if the answer is no, or maybe not, what are the threats?
Listening to Jensen Huang on the call was interesting because the point he made really clearly was that there was a massive surprise in networking. And he fell over himself to explain NVIDIA is not a GPU company anymore. It's a system company, right? So you buy the entire thing from him. Or them. So the idea is that NVIDIA is constantly changing. They also laid out their platform infrastructure architecture for the robotics vertical, which looks super interesting. So I think there's one thing you would never want to bet against with NVIDIA is their ability to adapt and be ahead. And if you listen to Jensen, he has a sort of analogy about positioning under the fruit tree before the fruit is ripened. So if you're under the right tree, you will catch as much fruit as possible. I think that's just embedded in the DNA of that company. Now, I think the risk, if there is one, is that the customer group, right, these hyperscalers, remains very concentrated. Now, if that's the case, as they're already doing, they're building custom solutions for themselves, TPUs, ASICs. Now they use Broadcom for that and manufacture through TSMC. So if that group stays really narrow, which I think is really unlikely, then that's a risk. But I think it just gets more and more diffuse, and that sort of benefits the NVIDIA solution.
Angus, NVIDIA is easier for me to understand. They've got many products, but one dominant product, the GPU and the cloud. But Broadcom, which is the second leader in this semiconductor space, what do they do, and what has been the source of their growth? Who is buying from Broadcom?
Broadcom's an awesome company. So it's, I guess, the simple way to think about it is the sort of intermediary between somebody who wants a chip and knows how they want it, and they want it a little bit cheaper than the overall NVIDIA solution. They'll use Broadcom to design and get that taped out with TSMC. You and I talked a year or so ago, and I was pretty nervous about this sort of development of custom ASICs, right? So you build your basic infrastructure on top of NVIDIA GPUs, and then you add your own stuff. So Amazon's doing it, Meta's doing it, Google are doing it. They would use Broadcom for that. So when I thought about phase one was hands down NVIDIA. That was the first layer. I then got a little nervous about a year ago on NVIDIA, and that changed about 3 months ago. So that sort of put us into sort of stage three. So stage one was just GPU. Stage two was more of a sort of dispersion of silicon options. Stage three now, how that is defined to me is just demand has come back to outstrip supply. Broadcom, Nvidia both do great. And that's just really two angles. One, you've got this constant up move of CapEx expectations. And arguably the hyperscalers will always be behind the curve for various reasons in terms of announcing this stuff. But also you've got sovereign AI dropping in, and then you've got this sort of acceleration and competition from OpenAI increasing the urgency on everyone. So I just feel I think it's very clear to me that there is the demand is going to outstrip supply for a while now, which gets you to a really interesting point, because we haven't talked about the sort of supply side of it. Because the supply side of it is everybody has to use TSMC. They have 70% market share. And when I talk about monopolies, this is an interesting place to put that idea in there. Look, monopolies arrive from the inability to find anyone to compete, right? TSMC beat out all its competitors by better customer service, better cash flows, higher margins, and then you end up with all the customers. And then when you've got all the customers, you've got all the cash flow, and your lead continues, right? So here's the issue with the entire supply chain, because it goes TSMC down to ASML for the machines, through Lam. But again, everything we have in that SMH stack is the leadership group, the monopolies. TSMC sitting there going, okay, I can see the demand coming in, but am I going to overinvest against myself? It's like they've got one competitor, and it's really them. And out of one eye, they can see this.
Who has one competitor, and who is that competitor? Sorry.
TSMC is really competing against itself, right?
Oh, yeah.
So it's theirs to lose, right? If they overinvest, right, it's because they made a sort of a wrong decision on expectations of demand. They can run the equipment they have super hot, right, and still meet most of the demand. They've got a couple of things outlining, right? One is these gigantic hyperscaler demand numbers, which they're huge, right? Google is higher than the defense budget of most of the G7 countries, right?
The UK, I saw that, yeah.
Yeah, higher than UK for sure. And then on the other side of that, the geopolitical risks. TSMC tariffs could go to 500% tomorrow. There's the sort of nagging issue of China. So the entire supply chain, I would argue, is underinvesting, not by a lot, but that puts a lid on how many GPUs or TPUs or CPUs can come out of that entire vertical. So everybody's margins should stay pretty high.
Broadcom, basically their customers are companies who they don't want to buy NVIDIA chips. They want to design the chips themselves. So Broadcom is like consultant. So Amazon, they don't want to buy as many NVIDIA chips, although I think they do buy a ton. So they hire Broadcom to build their Trainium model or something like that, right?
So each of these, that's a great question. So each of these hyperscalers have a lane, right? You know what Amazon is. Amazon does fast. It's like a bullet train. It does fast, efficient, and cheap, right? They can't be building an entire stack on NVIDIA GPUs. So they put a lot of their inference stuff through their cheaper, easier to make variants, right? So keep their cost down to their customers, more customers. Because at the end of the day, they have a huge customer base and a brand, right? Microsoft are doing something else, Google and Meta are doing something else. At the margin, they want to be customizing, one, to get lower cost overall, and two, so they have custom options for whatever variant of the business model they're trying to run.
So, Angus, there's a lot more questions I want to ask you, but let's just open it up to the investment side. SMH, the VanEck Semiconductor Fund, over the past 3 years, 5 years, it's actually beaten the S&P and the NASDAQ. So that's just the semiconductor beta has just absolutely dominated over those time horizons. But what's interesting to me is SMH has outperformed a lot of the other semiconductor ETFs. For example, its biggest competitor, it has outperformed on 1 year, 3 year, 5 year, pick your poison. So I know number one, congratulations. But I want to explore why that is the case, Nick, because one reason is I look at SMH and the weighting currently stands at a quite high, over 20% actually. And I look at the competing ETF, Nvidia's weighting in that ETF is less than half that. So that is, I guess, an example of Nvidia has just been this huge winner, and in your ETF, it has been a much higher weighting than in its competing ETF, and that's why your ETF has outperformed. That's an example, but speak to the broader principle of why that is the case and why it may continue.
So I would take a step back and try to view how we structure and intelligently design our ETFs. It's very thoughtful, and we try to have a very long-term perspective when we're working with indexing companies to put together these passive indexes so we can build the ETFs. And it's different dependent on whatever it is. So for thematics specifically, we always try to be the pure play in the space, right? We don't want things to be watered down. Within semiconductors, it's pretty easy to do that. There's enough semiconductor companies out there. You're not going to get Google or Amazon inside of there because they're not 50% or more revenue from designing semiconductors, right? Apple would be the same thing. They're a fabless company. They design their own M1 chips, but they're never going to qualify because they're not a semiconductor company. So that's like first parameter, is just looking at making sure we're the pure play in the space and companies driving the majority of the revenue. So easy to do with semiconductors just because it's a large industry. Secondly, you try to look at what kind of weighting methodology do we want to put in place dependent on the theme or the sector or whatever it is that we're trying to allocate to, right? Because at the end of the day, we're trying to provide agency to our clients to make sure that they can build a diversified portfolio and they can allocate to something that is going to give them the exposure that they're asking for. So when it comes to semiconductors, it was just pretty clear to us, and really in other high beta areas, that you really just need to let the winners run, right? You need to allow the market to do what it does, right? The S&P 500, the top companies, you hear about the Mag 7 all the time, but that's why the S&P pretty much outperforms all active managers, because they're trying to make bets or unintended bets rather on specific companies. But when you just allow the market cap cycle to work and these top companies to move up the stack and really drive performance, it can be a huge differentiator between us and the peer group, right? So I think that's what we've seen largely between SMH and our top competitors, is that we constructed this to allow the winners to just move up the cap naturally, but while still obviously following regulatory rules, because there are those in place, right, where you can't even have more than 25% in any one company based on RIC diversification rules. But we really want to push that envelope in specific areas. And we definitely did that with SMH and SMHX, allowing top companies to get up to 20%. And that's what you're seeing with Nvidia, right? Not getting in their way or trying to play a pseudo active manager with weighting methodologies, and just allowing the top companies to naturally move up the stack. And if you look at SMH prior to 2022, Intel was a top holding. I think it was the number one holding prior to 2020. Now it's not even in the top 10. So the evolution of the index naturally happens, and we just kind of want to set the parameters in the beginning with what we believe are going to be long-term tailwinds, and just let the portfolio run and not step in and not try to make unintended bets.
It's a great explanation from just an investor perspective, right? The problem always with ETFs is you underwrite the losers at the same time as you underwrite the winners. Now, the design of this is like it's constrained by market cap, right? So it's only the owners. So we talked about the monopoly piece. So naturally, it blends out the losers. The other piece is just the counter narrative that we run into all the time, which is like your question set up, which was like SMH only does well because you've got such a big position in Nvidia. So if you think about risk, so risk one, SMH kind of blends out the losers and concentrates mainly on the monopoly winners. But two, like the large position SMH said is an output of the process. It's not an input. Nobody's actively saying let's hold a massive position in Nvidia. We basically say we constrain market cap, 25 holdings, and weight as close as we can to exposure, and that's where we end up, which really that is the performance in the past.
So the cap on the largest holding in SMH is 20%. Nvidia is slightly higher than that, I assume, because as of the last rebalance, it was at 20%, and then it has rallied, so that's why it is. And in other ETFs, I don't want to talk about their methodologies, but it may be lower than 20%. So Nick, would you say that is the only reason for the outperformance in the methodology, or are there others?
Some of our top competitors switched indexes, underlying indexes previously, I think as they obviously we monitor the peer group and see what's going on, and you can comb through the documents to see what they've done. And I think some of our competitors saw the success of SMH, and some of them were not global when they did it. So we allow global companies US listed, so you get ADRs in there, right? So for a long time, some of the top competitors didn't even have ASML, they didn't have TSMC in there, right? So that's a huge drag on performance when you've got two pretty close to monopolies that are driving a ton of the underlying performance in the semiconductor space, and you're not even allocating to them. And that might be a byproduct of maybe some of these other ETF providers. Just semiconductors traditionally were, you could say, a trading vehicle, or if they're a secular thing, say very cyclical. So they weren't really paying attention to the methodology, and it didn't really matter because people were using it. But then you start to see the emergence of AI, and it's like this becomes such a pivotal building block to the foundation of this technology. All of them went back to the drawing board and had to adjust, right? And we were set up to make sure that, again, being very thoughtful about the initial index construction to make sure that you're getting a full scope access to the space, right? Because SMH gives you the fabless companies, it gives you the foundries like TSMC, it gives you ASML, the equipment companies. You're getting the full stack all the way down, like Angus says, and you're allowing those, whichever company it is, to continue to run in that space. So I think a combination of those were what has propelled us over the long term. And I think it just goes back to what Angus is saying. It's just like this is a product of the thoughtfulness in the beginning, and not necessarily us to manipulate and become it being an output rather.
It's interesting because I think people like this whole cyclicality thing is a bit of a problem, I think, when you come to think about portfolio allocation, right? So from a sort of 30,000 foot view, semiconductors as a foundational technology behind every innovation we've seen, like internet, smartphones, AI, right? It's the engine of modern productivity. Now, if you look at a chart of semiconductor demand or unit sales, whatever, over 20, 30 years, it only goes up. So where does the cyclicality piece come from? The cyclicality piece comes from the idea that there just used to be like a bunch of semiconductor manufacturers and designers all competing against each other for the most business. They were all making the same thing. That has ended, right? As I say, mostly monopolies all the way down the stack. So in theory, semiconductors certainly have and probably will move forward as being much more cyclical. And really one of the sort of biggest edges I feel as I approach investing is this idea that most people still think this is very cyclical. So if I think about positioning against expectations, let's assume these companies in the lead group, right? We're only talking about the lead group, right? The stuff that's in SMH and SMHX. Let's say they are a lot less cyclical. Then back that into a basic sort of Sharpe ratio PE model, like lower volatility equals higher multiple. All of it points into the direction of you want to be in the better quality names. One, because they're monopolies. Two, because they're compounding over time. They have higher return on equities. So they pay shareholders. But three, because if you go back 30 years, semiconductor demand has never been cyclical. That's just a reality.
And this is my view, to be clear, what I'm saying, my observation, which could be wrong, but I look at SMH and I look at SMH's competitors, and I think SMH does have a higher weighting of what is perceived to be, or what the companies that have grown their revenue the most, and not the old school. I'm not even thinking of the biggest competitor to SMH, but there's some of the other ones just have the biggest weightings as these companies that were dominant in the 1970s, but they make very old school stuff. And by the way, I'm not even super bearish on the old school stuff. I actually think during this AI boom, the old school stuff has not grown that much. So I think the old cyclical stuff could do well, but I just think it is my observation that the leading edge stuff, the highest weighting is in SMH.
Yeah, spot on.
So Nick, talk to me about the VanEck Fabless ETF, SMHX. What motivated this? How is it different than SMH?
Sure. Slightly fortuitous timing, but we try to be thoughtful again when we're looking at this. And I think a lot of it boiled down to seeing the success of SMH, the construction of it, what has made it successful, and then starting to look at those top holdings and which ones were continuing to shuffle to the top. And it all tended to be these fabless companies, right? You've got Nvidia, you've got Broadcom, you've got Qualcomm, you've got this fabless business model that allowed Nvidia to pivot on a dime from a gaming GPU company to a data center provider, because they had the foresight to understand that there was a lot more things that these GPUs could do, but then also the business model itself and not being so vertically integrated, allowing them to design chips and get them out at a much quicker cadence. We started looking at really how fast things were transitioning in AI, right? And how this upgrade cycle and these things were happening and how quickly the cadence was. And it just looked, ultimately at the end of the day, the companies that are going to be most successful are the ones that can iterate quicker, right? And it's a lot easier to iterate quickly if you don't have the manufacturing aspect tied to you. Second to that, all that capex that you're spending, they're allowed to, now they are freed up to go put into R&D, right? So now not only can you be quicker on the cadence with coming out with new designs, as we're seeing Nvidia do to stay ahead of the curve, but then you've got this whole other layer of companies that can iterate quickly, they can optimize, and as we move into this application layer, can design new chips to make these systems and these data centers more scalable, right? So as Angus says, when you're looking at your mental model and you're trying to build a roadmap, it looked ever increasingly likely that some of the biggest winners in this technology were going to be the fabless companies, right? And as we're constructing an index, we got to make sure that there's enough constituents out there, that the universe is large enough, and it was, right? So it just really checked all the boxes, and it was green lights just across the board as we started to dive into it, and it just made a lot of sense, and kind of all the dominoes lined up just at the right time. And it was the timing wise, trying to make sure that we weren't too early to it, that we were letting this kind of thesis play out, but then also not be behind the curve.
Jack, you and I talked about this like a year ago. I'm not going to go through it again. What Morris Chang, the dude who set up TSMC, what he did was he took the cost of machines and building crazy sized factories and fabs away from cool chip designers, right? So he started this trend that more so than anybody else, than without that business, Nvidia wouldn't be what it is today. So effectively, if you take away all of that cost from somebody's balance sheet and let them focus purely on design, you have a very different business model. You have a business model with very high margins that can move fast. High margins generally means high profitability. There's high optionality. You get to hire the best people, right? So the best people tend to be at the fabless, which means that that's self-perpetuating. So the one big trend that I don't think enough people talk about is like the rise of fabless and how that's created these monopolies, right? And really that's the problem behind Intel, was that they never separated the two, and they were never good at customer service. But if you are either a fab or you're fabless, customer service is all that matters. The idea was like in SMHX was like these businesses that are designing the next silicon that is going to be in optimization layers and data centers, power, data optimization, design for purpose solutions, they're never going to be big enough outside of the top two to get into SMH. But that's where the action is, because we can see a long roadmap. So how do we build something where we can capture just simply that vertical, that cohort of businesses? And Nick's crew came up with this idea, and it's an awesome one.
So over the past many decades, there has been a bifurcation, a specialization of the designing of the chip and the manufacturing, the fabrication of the chip into two different things. Okay, Angus, I'll focus on making the chip. You focus on designing the chip, and I'm in Taiwan, and you're elsewhere. And SMH has the fabs. So with the dominant player is Taiwan Semi. Then competitors to a lesser extent are Samsung and Intel and some others, but TSMC is really dominant. But then SMH also has included in fab is the companies that sell to the fabs like TSM or Intel. So that's ASML, Lam Research, KLA. And those are interesting businesses. ASML is quite unpopular in the market these days for various reasons. But you look at like the Lam Research, and a very smart investor I know has pointed this out, that like Lam Research has so much basically implied revenue that's basically guaranteed, because when they sell a machine, they have to service that machine. So the revenue is going to be baked in no matter what. But SMHX says, okay, the fab is great, and that's an SMH, but we're going to specifically focus on the fabless exposure. So no TSM, no ASML, no Lam Research, no KLA, and just focusing on chip design. And so it doesn't have those companies I just mentioned, but then it also has companies that are fabless that are not in SMH, such as Astera Labs, such as Allegro Microsystems as well. Angus, how would you describe these companies? Where do they fit into the stack? Are they on the rack? Are they designing other stuff for the data center? Are they NVIDIA wannabes? How would you characterize these?
I think back to the binoculars thing, right? You've got to throw your scope out. So this is what's coming. These guys operate in the what's coming space, right? So let's say you've built a data center and now you can't get any more power, right? So what's coming is you need to use less power. So these guys would design data optimization silicon or power optimization silicon or networking optimization silicon, and they'll be everywhere, right? So they'll be in EVs. How do we design an integrated circuit that allows a Tesla to use less power, right? Nvidia's hunting the bulls, right? These guys are hunting smaller prey, but maybe even they're turning up and eating the bulls as well. But the reality is that the scale of Nvidia means, and Broadcom mean, that they're unlikely to want to be innovative around this stuff. It's like, drug companies, right? The large drug companies don't do a lot of the innovation. That's out to the left or right by biotech businesses. They take that risk. The returns are amazing if they hit it, but they're just very sort of distracting for the big guys. So the big guys are doing the big stuff, and at the same time, because tech is moving forward so fast, there are incoming demands. And you really, again, going back to just what has been the role of semiconductors for the past 30 years, it's effectively to increase productivity. So the fabless guys are just sitting back there saying, okay, this needs a productivity fix, this needs a productivity fix, designing the silicon specifically for that, and then layering software on top of it and selling it as a bundled solution.
I would say too, just we call them hyperscalers, right? They want to scale faster. So they're building these data centers. They set up the blueprint, GPUs lead the way. Then you've got the custom ASIC chips dependent on what the needs are for the underlying business and what they're trying to optimize or to do. But then you've got these data centers that they need, like you said, you need more to be more efficient. You have better interconnects. You need all of this optimization to help them scale even more. And that's where these fabless companies step in and can fill that gap because the margins are too small, maybe for an Nvidia, say, or a Broadcom, but it's not for the guys in the garage, as Angus would like to say, designing new things that are trying to make these data centers and everything that has a semiconductor in it more efficient. And then you talk about moving out to the edge and how much we get more to closer to edge computing. These fabless companies are going to be the companies that step up and can provide that because it makes sense for them to take on, like Angus said, that risk to design something new to help us become more optimized.
And are these companies, do a lot of them have Nvidia or the hyperscalers as a client? Because I assume obviously the hyperscalers have a ton of cash and capital. Nvidia has a ton of cash and capital, and TSMC has Nvidia as a client. So Nvidia doesn't mind as much if TSM raises prices because there's a lot of pie to go around, so to speak. Does the other companies, do they have that as well, where Nvidia is just raking it in, so maybe we could have a little bit of more pricing power as well?
Again, the recent call from Jensen Huang laid it out really well, which is if you can transfer value, right, from what you're doing to your customer at a high enough level, you're creating value for customers. So meaning, like, if you can save them 10% power and the cost of saving 10% power is 20% of what you're going to save, you've got a market, right? But I think that's the way to think about it, is that every innovation in silicon going forward makes the outcomes for those customers more efficient. And I think that's just really simply how to box it in.
That makes sense. And Nick, I want to share a thought. I have your input on it. Is in the ETF business, especially recently, I think there's a lot of what I observe of creating an ETF just so you can create an ETF. And there are products that offer very similar exposures to what is already exists out there. So I'll give an example, like an ESG, not to trash ESG by any means, but there are ETFs that are the clean S&P 500, and it's basically the S&P 500 minus ExxonMobil and maybe minus one other oil company. And that is an exposure that investors want. They want green, they want ESG, and that's great. But really, if you look at the tracking error to the S&P, it's basically identical. I look at the performance of SMH for an SMHX since it launched, and obviously they are quite correlated, but it is offering a different exposure. And there are companies in SMHX that are not in SMH, and there are companies that are in SMH, some of which have a decent sized weighting, that are not in SMHX. So can you just speak to the example that, like, they really are different?
Yeah, for sure. I think there's 5 to 6 names that are actually the same when you look at the naming, the actual names in the portfolios. It gets skewed by the weightings, and I think people get caught up on that a little bit. But I think if you're allocating to the space using both of them, you're getting a much more clear exposure to the entire ecosystem of these companies that are all winning together, right? Like Angus says, these are still pretty focused portfolios, right? 25 names in SMH, 22 names in SMHX, and we just looked at SMH, and you look at the opportunity set, and you're just missing a lot of names that are really attractive, and there's a lot of upside, and they're doing a lot of really cool things, and it's an exposure that nobody is getting, right? To that point, we're not like, say, if you definitely get investor preferences like that if you're talking about ESG, et cetera, where they just don't want exposure to things. But when you're looking at a subset of an opportunity and you're just saying, listen, there's just a lot of names that are on the table that no one's getting exposure to across the board. You could probably look at a lot of different technology ETFs out there, semiconductor ETFs out there, and short of having 50 or 60 names, which is going to be a drag on performance as a whole, you're not getting the exposure to these SMHX names down the stack. So for us, it wasn't about just, hey, we want to be first to market. This is cool. It's just, no, there's a big opportunity set here that investors are missing out on, and how do we give them access to that space? So I think you can't get caught up in like the portfolio weight, because you buy both of them, you're not losing any exposure to Nvidia. You're getting pretty much the same across both, but you're getting all these other names in the portfolio that you aren't getting in SMH. So that's the way that we looked at it and the way we approach it with clients.
And does SMHX also have the 20% maximum cap?
Yes, that's correct. The weighting methodology and all of those different things are almost identical. The only difference being the number of names, just because there are a few less names in the fabless universe. So you got to make sure that there's volume, liquidity, all those different things, so that we can do the correct thing from like a managing of the portfolio standpoint. But largely, yes, they're almost identical, except for the fact that you have to be fabless. You have to outsource all of your manufacturing to qualify for SMHX.
And how should people be thinking about allocation to say, okay, I want to invest in semi ETFs, and VanEck has a good performance. We look at competitors. How should people be thinking about allocation to SMH versus SMHX? When you're speaking to clients, what do you recommend and how people think about this?
Yeah, obviously it's not a recommendation of do what's right for you and your clients and your risk portfolio. But we try to approach it as like you're just getting a much more holistic view of SMH, owning both of those together. And then based on your risk tolerance or the client's underlying risk tolerance, you would split that allocation. For those who have SMH, it's a great diversifier. For those who maybe are invested in some of these high flyers within the semiconductor space specifically, it's a single stock risk is a real thing. Looking at the success of some of these top fabless companies and being able to just buy a broad basket, that's the thing that Angus and I have been pounding the table on, right? Is remove the single stock risk and diversify across a set of names that are all poised to do well, because there are going to be reversions of the mean. That's how the markets work. Even if you're in this transformative technology, things happen. And being diversified across a set of fabless names over the next 10 years, we believe is a great opportunity.
Angus, tell us about the biggest weight in SMHX that is a company that's not an SMH, Astera Labs. It's got a decent size as we record in late August, a close 6.9% weighting. What does Astera Labs do, and why does it have such a big weighting?
It's connectivity. So basically it's networking. Again, and weirdly, that was something that Jensen Huang talked about. So as you follow the sort of build out, for example, of AI, the early stages was just single GPUs as a node. Then it became rack level as a node, and now it's become system level as a node. But effectively, the more juice you want to get out of a set of data requires you to use more and more effective, say, GPUs or TPUs, but also the way you network them all together, right? To run, because they're all running parallel processes at the same time. You want speed, you want power, and you want efficiency. As you build out intelligent connectivity platforms, right, in AI infrastructure, pretty much everywhere, you need like the best of the best networking switches, how switches communicate with each other, how they talk vertically, horizontally, laterally. It's a big piece of the whole pie.
Angus, I know Nvidia has been somewhat acquisitive over the years. In the book The Thinking Machine, I read about how Nvidia bought Mellanox, a company out of Israel that is in that space, and I know Jensen is extremely happy with that acquisition. Do you think Nvidia would ever continue to be acquisitive and maybe buy some of those fabless designers as well and expand horizontally by acquisition, or because they certainly have the capital to do so, or is that not part of their strategy?
Oh, totally. I mean, tuck-in acquisitions would work great for these guys, and they've done it. Part of their, I can't remember the name off the top of my head, but part of their success in networking was an acquisition. They would totally do this. And again, I think if you think about it roughly along the same kind of model as a large drug company buying a biotech company, it's a similar kind of thing. There's no question that they are very forward-looking, right? And there's going to be specific skills that they don't have, and they will absolutely go out and acquire them. And I'd say tuck that in and broaden it across, because any business is probably worth more to Nvidia than it is to anyone else. The price that they're going to be willing to pay means that they're probably pretty successful on whatever target they would choose.
That makes sense. Angus, I've got a lot of things I could ask you about, but what's on your mind?
I think the bit that's on my mind very much is just like what's happening on the customer side, because there are a couple of things that don't make sense going forward. The
Like
first
what?
one is monetization, right? If you think, Jack, and you say to me, dude, I've become 50% more powerful. I was going to hire somebody and now I'm not. So Jack's got 60% more power, 50% more powerful, and OpenAI because of that got paid $200 a year, right? So there's something wrong with the sort of the value transmission. So I'm not sure how the monetization will work on that.
You're talking about individual employees being paid $200 million a year, to be clear.
Yeah, no, 100%. What I'm saying is the value transfer, right, that say ChatGPT is giving to its average customer is significant, right? So let's say, you become 50% more efficient. I don't know how you would value that, but it's a lot more than the $200 you're paying, OpenAI a year to have ChatGPT. So at some level, that monetization has to go up. I'm not sure how that works, but I'm pretty sure that LLMs are not the application layer that say apps were in Internet 1.0. I think there's a real problem there with sort of enterprise grade trust, that there'll be an entire group of verticals on top of that will take care of very deep specific problems, whether it's legal or accounting. Because at the end of the day, an LLM is becoming more focused on how much you like it, right? So the answers you're getting, and you can see them if you use them, are very focused on answers you like, not answers you need. And engagement's a super important part of an ad revenue driven model. I think what happens with monetizations at the LLM level, and then what happens with user engagement and how that conflicts with the integrity of an LLM. Because at the end of the day, look, you've just gone from 10 blue links, right? Which is awesome because you get to choose between one of those 10. So me, the user, has agency, or I believe I do. Now, they may all be wrong, but that's reality. To one answer, right? One answer is actually not great because you don't know what's going on behind that answer or how they got to the answer or what the source code of the answer. But you've got to assume that you and what they've learned about you is a big part of how that answer was built. If you think about it in the most sort of brutal way, that the power used to be data, right? And now we've gone to the power is just the ability to give a single answer. And I don't know how that trust proposition builds out, because that answer is more likely to be customized to each individual user. But I think at the end of the day, I think it just gives me very clear line of sight that there's a whole layer on top, and that's more compute, more semiconductors. And I think that's just a piece that people haven't got to yet.
Okay, so that's a really big deal because OpenAI, the dominant bot, they are losing lots of money. Anthropic also losing money. A lot of chatbot companies, probably most of them, are losing money because they're not charging nearly as much as they are spending on building out the data centers. Presumably, they've got to start making money sometime because they can't just keep raising money from venture capitalists to invest in Nvidia. So for this to be sustainable on a long-term basis, I think they've got to be profitable. So if they aren't, that is definitely a challenge to the bull thesis. But what does that mean? So how, if they can't monetize the chatbot, which as much, which is I think what you're saying, what is that layer on top?
I think they can is the answer, right? I just think they haven't gotten to it yet, right? So there's going to be some kind of ad layer. I don't know. With OpenAI, with ChatGPT, you'll have to put your credit card in there so they can take a piece of something they resolve for you. If you say, find me a flight to wherever, check my calendar, do all the stuff, email my mom, they'll take a piece of that for success. So there'll be a take rate probably layered in there at some point. There'll be other. They've just hired a pretty aggressive and successful team on monetization, but I think the monetization piece also, just as I say, runs into this trust piece. I don't think monetization is a problem. I think ROI is there. I don't that's the issue. The issue really is just like what is the fundamental conflict or tension between a user engagement / ad revenue model, right, and the single answer source of truth value prop. I think there's some grind there, but I think the resolution of that grind is that another layer builds on top. So I don't think anyone loses. I'm super positive across the board.
So the monetization for the large language models, the chatbots, is not there right now, but in the medium to long term, you're not concerned about it. Angus, what about the companies that on paper are very profitable companies? Now, the hyperscalers, Microsoft, Amazon, Google, they are extremely profitable, but on their spend on capital, they buy a ton of chips from Nvidia, is spending close to $100 billion a year per year, and then their revenues go up by a lot. The accounting of that is that when they buy a chip, it's an investment, so it's not an expense from the income line. It comes from the investing cash flow line, and then the cost is depreciated over time. And they use a weighted average life of 10 to 12 years. So let's just say it's 10 years. So every year they depreciate. If they spend $100 billion, they depreciate. They take a $10 billion charge. The next year they take a $10 billion charge, and this is causing their earnings to go up a lot. There is a criticism from noted short seller Jim Chanos, and I saw you engage with him on Twitter. That basically, if this technology is so transformational, really in 10 years, these GPUs are not going to be worthless, but they're going to be far less valuable. And for example, I had suite mates in college who were mining crypto with Nvidia GPUs probably about 10 years ago. Those Nvidia GPUs at the time were somewhat cutting edge, but right now they would be incredible laggards. So is it not appropriate to have a weighted average life of 10 years and more like 3 years? And actually, you shouldn't be taking a charge of $10 billion depreciation per year. You should be taking a $33 billion charge of depreciation. And ergo, the ROI is a lot lower. What I saw you interact with that argument with Jim Chanos on Twitter. What's your reaction to that argument? How are you thinking about it?
So I think what happens is ChatGPT would give Jim Chanos one answer, and I think ChatGPT would give me another answer because they'd know where his biases are and they'd know where my biases are. You can make both arguments. That's the point I'm trying to make. You can make both arguments. I think it's the 10-year depreciation amortization is on data centers. That's the line in most accounting roadmaps. Now, what is a data center? It doesn't break out what the GPU is, what the land is, what the power is, what the initial infrastructure input is, because if you build a data center and you do a one-off deal with a defunct nuclear plant, right? Where do you put that? Do you depreciate that over 20, 50 years? I'm not sure. But what we're getting in those sort of like depreciation cycles is the blended period or duration to depreciate the entire cost of the data center. And now we know that the data center, like the total cost is about 80% capital, but we don't really know exactly how that's split. You can probably get close-ish to it. But the other piece in that is you're accruing intrinsic value as well. How does that work? Because if you build a data center with a GPU that only lasts 2 years and you acquire a bunch of customers that last you 20 years, where do you put all that? I think it's a difficult argument to get into because I don't think there's a very clear answer. But I think where I would lean on is that the shareholders have been pretty efficient at punishing overinvestment or poor investment. I mean, Meta was a great example 2 or 3 years ago. So I think they've got and again, Google are showing you the same thing. They are under investing, and Google's underinvestment was in usage of their AI cloud, right? So they've got customers demanding more than they're capable of giving. So I think that becomes a problem when we get to an overinvestment point and shareholders start to punish individual companies. But up until now, it's difficult to really make conclusions on what the appropriate depreciation cycle should be. It looks about right to me. But again, I wasn't I was being a bit destructive in that tweet and saying that's probably not the right way to look at it. So you shouldn't be screaming about it. But I don't know.
Is that argument that the depreciation schedule is too delayed and basically the ROI that's reported should be lower actually because you should have a shorter depreciation schedule? Is that argument, in your view, the strongest bear argument, or is there a stronger bear argument that you think of? In other words, if your thesis is wrong, what do you think is the most likely reason why?
It's got to be something asymmetric, right? First of all, I think to me, if you're going to be wrong, or if I'm going to be wrong in my sort of overall thesis, then it's probably going to come from one of the big things that either geopolitical, some kind of global depression, or some kind of regulatory intervention, or a big tech inflection. Big tech inflections have pretty destructive. But again, whether that's, I don't even know what that would be. Maybe quantum computing. I'm not sure. But right now it's difficult to see. The energy problem isn't a huge problem. The capacity issues seem to be in a pretty decent place. So yeah, I mean, I look, I try to look 3 years out, and I try to look with both barrels of binoculars focused at that point in time, not one focused in the past and one focused in the future. And supply demand looks pretty healthy out there. So it would have to be one of those sort of big asymmetric, idiosyncratic type wrecking balls.
Yeah, and this is a sponsored fireside chat, so we obviously want to talk about SMH and SMHX. And I think the point is, like, if this is not to say you should allocate to semiconductors or you should not allocate to semiconductors. Angus, you're just sharing your own views. Someone who's been involved in the semi space for a while. I think one thing that we are saying is look at the performance of SMH and SMHX versus its competitors in the ETF semi space, and then look at what Nick has been talking about in terms of the weighting and the methodology. And is the outperformance of SMH versus competitors, is there a reason that it could continue? And if you are going to allocate, consider SMH, and then also consider its brethren, SMHX. And one thing, Angus and Nick, I want to say is there is hype around AI, and there's maybe a little bit less hype around semis, which are totally crucial for AI. I hope that's one message people take away from this. But through the investment worlds, like I've seen hype cycle, both of you have seen way more than me. And I think a lot of hype cycles around things that don't deserve any hype whatsoever. 3D printing or Internet of Things, like they were cool, but they did not really lead to large increases in productivity or revenue. Crypto, I would say, is still searching for a use case. Perhaps some people would disagree with me there. Quantum computing, Angus, you mentioned, like it could be big, but Martin Shkreli, who's a quite smart guy, has made a very compelling bear thesis, and he thinks all of quantum computing is like a total bubble. I don't think you could say that about the semiconductor space. Like the biggest companies and the most profitable companies that have ever existed are spending a ton of money on semiconductors, and that is just a fact. So that's not really a question, but I just want you.
And I think I sort of made that point earlier on. Like, since they turned up, right, semiconductors have driven productivity globally, and I don't think that changes.
100%. Silicon makes everything better, and it's in every piece of technology that you touch, from your smart toothbrush to your self-driving car to data centers and GPUs, right? And I think people have to wrap their head around that it's not quantum computing, and it is very integral to every part of our everyday lives. And these companies are real revenue drivers, and they're driving real innovation.
So thank you, Nick. I hope over the course of the conversation, the SMH and SMHX versus its competitors in the ETF, semi-ETF space has been clear. Make the case, Nick, although, of SMH or semis versus the S&P or versus the NASDAQ. As I said earlier, on a 3-year, a 5-year horizon, I think people would be happy with SMH relative to the S&P. Share us your views here. Don't get too bullish.
Yeah,
Just tell us.
no. I think you could make the argument that 20% of the NASDAQ is SMH. If you look at the top winners, and if you could really want to dive in, there's probably more performance there. In my mind, it definitely, you could make the argument for that sleeve of the portfolio, an alternative or an addition to, because there's obviously going to be names in the NASDAQ that you're not getting in SMH, but a lot of the top companies in the NASDAQ are holdings in SMH, right? That's the way that we view it. I wouldn't put it up against broad markets like the S&P, although some of the top constituents are obviously the same. But for those investors and our clients who are looking at broad tech and saying, where's the opportunity? I think you have to lean into the semiconductor names. And I think you could easily make the argument that SMH is a great alternative and or addition to an allocation in there.
Angus, final question is, I looked at the Microsoft earnings call, and they implied what I perceived to be that they implied that over the next 12 months, they would spend over 100 billion and 120 billion. But then I look at the Microsoft CapEx estimates from Wall Street, and they say 100 billion. So is there a underweighting or a, what's it called, sandbagging from analysts? Like, analysts are still sandbagging how much these companies are going to spend?
Yeah, I think there's a lot of sort of weird dynamics going on there because if you think about it, if you're about to buy a bunch of GPUs, you don't want to tell the guy you're buying them from that you're about to buy them, because it's a negotiation in terms of when you get them. And so I would say underreporting is probably more likely, but also I think just the bigger mistake is this sort of idea that companies aren't great judges of their own needs. So on the analyst side, they'll fall either side of that. But I follow dispersion of analyst earnings really closely. And because if all the analysts are super close together, they either see a lot of risk or not a lot of risk. But I think analysts generally try and right size numbers into guidance. I think the problem with Microsoft is the guidance is here, and you can't fit that order of 120 billion into the guidance. It's about reconciling. So I think that's a lot to do with it.
Thank you, Angus. We'll leave it there. I appreciate everyone watching this. I hope they learned a lot. If they want to learn more about SMH and SMHX, go to vaneck.com/SMHJack and vaneck.com/SMHXJack. We'll include those links in the description. Also, make sure you follow Angus and Nick on Twitter, Angus Shillington and at Nick Frasse SSE. Thank you both. Until next time.
Thanks, Jack.
Thank you. Just close the door.